Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended November 9th, 2016. As I think a lot of people can imagine, we actually had a lot of turbulence in the market this week, and that equated to quite a big outflow. We saw about $12.9 billion exit the conventional fund business. That's ex-ETFs. Certainly we'll talk about ETFs as well. I mean, this really was kind of just a really roller coaster week for investors to ride through. We had the FBI reopen the investigation to Hillary Rodham Clinton's emails, and then by the weekend they said they were no longer going to do that. That caused market turmoil in there. We saw the nine consecutive days of the Dow being in negative territory. We haven't seen that since 1980, so it was the longest run in that. And then, of course, we had the presidential elections, with most people on Tuesday believing that Clinton was a shoo-in, and by Wednesday, everybody realizing that, in fact, the Republicans swept the elections by taking the presidency, the House, and the Senate. Well, let's see how that panned out into flows and what actually happened by taking a look at our macro group. Equity funds lost about $9.1 billion. Again, this is ex-ETFs. We'll talk a little bit more on the dichotomies that we saw there. Taxable bond funds lost about $3.4 billion. Muni bond funds took in about $37 million. So really, it's close to zero. And money market funds lost kind of their smallest amount that they've seen when they hit a losing streak of just $0.4 billion as well. And that brings us to wanting to kind of do a deeper dive into the groups that we just mentioned. I'm going to take a look first at equity funds to see how the elections and all that panned out here. We actually had a 2.49% return. I think everybody saw and were particularly amazed. We had strong returns on Wednesday, which really brought it up for the week, week to week, Wednesday to Wednesday, with again 2.49% return. First week in three that we've actually seen plus side returns. But if we take a look at what happened to flows, it was as we would expect. People are very concerned on the mutual fund side. $9.1 billion in outflow. This is the 35th consecutive week we've seen outflows from the group. And how it broke out, we saw domestic equity funds lose about $7.6 billion, their 40th consecutive week of outflows. And they had a 3.27% return, though. So people kind of got caught unaware. Now, if we look at the non-domestic equity funds, we saw about $1.5 billion in outflows. And it's the 7th consecutive week they've seen outflows, but they had a return of just 0.87%. Now, if we break that down a little bit further, we saw the lion's share of money come out of large cap funds. Basically, they saw about $5 billion exit their coffers, and then we saw about $1 billion exit the global equity fund universe. So really, this was quite a story, but we come to a kind of a splitting point, and I've been talking about a tale of two cities for many, many moons, so I guess it's not a new deal. Equity ETFs actually took in money this week. We saw about, for the 5th consecutive week, $9.4 billion enter this group. And of course, at the top of the list, as it usually is, when people are expecting some good news, but we're not sure which direction it's going to take, S&P 500, the Spider S&P 500 ETF, SPY, actually took in $6.5 billion. iShares Russell 2000 ETF took in $1.3 billion. So we really saw some people putting some, if you will, pedal to the metal on the ETF side. And of course, these are authorized participants, not retail investors, and they were making a bet there. And if we take a look at the bottom side, we saw some problems in some tech stocks. So as we might expect, the PowerShares QQ Trust 1 actually saw about $1.1 billion in outflow. And of course, iShares MSCI Emerging Markets saw outflows to about $800 million. So not a lot of story there, but what a dichotomy between retail investors, big outflows, ETF investors, authorized participants, big inflows. Well, let's take a look at another kind of change in status, so to speak, and that was for fixed income funds. Fixed income funds witnessed their third consecutive week of outflows. I'm sorry, second and third week of outflows, losing about $3.4 billion. But it's the third consecutive week we've had negative returns, this time to the tune of just minus 0.06%. The big attractor of money, and it wasn't much to talk about, was corporate investment grade debt funds. Basically saw about $217 million, fourth consecutive week they've seen net inflows. And then we take a look at government treasury. People were worried, so they put money to work, and they put money to work, but only to the tune of $120 million. Everything else was outflows. And corporate high yield bond funds actually took a bath. People were getting rid of risk, at least in that portfolio. And of course, on risk, the idea that we'll have rising inflation, and of course, everybody's still anticipating a December rate hike by the Fed, so $1.8 billion left that group, and that was kind of an amazing feat that we saw all this. We saw treasuries, we saw some corporate investment grade, but really taking the foot off the pedal for this group. Let's take a look at the ETF group as far as fixed income goes. We saw about $2.7 billion net new money come in the group, 7th and 8th week that we've actually seen inflows into this group. And at the top of the group, we saw iShares TIPS bonds taking about $920 million. Well, this is kind of amazing because if we add the inflows to the open-end funds and put those together, we actually saw the second strongest net inflows into TIPS. Second strongest since we've collected TIPS data on a weekly basis since 2002. So investors really were putting the bet back on that interest rates, not only interest rates, but truly inflation was going to rise. And so we saw that. It's been quite a trend we've been watching. As we take a look a little bit deeper, SPDR is the Bloomberg Barclay High Yield actually took in money, $612 million. And at the bottom of the barrel, we saw iShares 3 to 7. We saw the SPDR Bloomberg Barclay short-term corporate actually lose money, about $321 million. But again, really interesting that over the last several weeks we've been talking about two things, TIPS and loan pars, and certainly that has a big inflow on the TIPS side. Let's take a look at how this panned out for muni bond funds. It was really quite a ho-hum week for muni bond funds, only $37 million. Second week in 3, they've seen inflows. And for the first week in 3, we've actually seen negative returns, 0.64% this week. National muni bond funds actually took in $39 million, so that would tell us that for the second week in 3, they've outpaced their single state munis, and single state munis obviously were on the downside and had negative flows. Let's go ahead and take a look now at money market funds. This has been quite a story over the last several months as we had the new rules in money market reform, but really this week turned out to be what we'd expect. Kind of a ho-hum week. First week in 3, we've seen outflows, $385 million, almost nothing. Taxable money market funds actually saw about $0.5 billion, a little under $500 million in outflows, and how that equated. Institutional investors actually pulled out about $8.9 billion, while retail investors, again we were talking about this risk-off play, put about $8.4 billion back into the coffers of money market funds. So not the story we've been talking about in the past. And tax-exempt money market funds also took in about $129 million. Really, as we've been talking over the last several weeks, not a big deal for tax-exempt money market funds. We think the reform influence on money market fund flows is pretty much out of the equation now, and it's back to business as usual. Well, that's it for me this week. If you want to take a deeper dive into some of the classifications, groupings that I have not talked about, please visit us at www.lipperusfundflows.com. If not, join us next week when one of our analysts will talk about the flow trends of the week. My name's Tom Roseen. Thanks for joining me. I'm wishing you the best in your wealth planning and creation.